Good afternoon, everyone. This is my first post to this video blog. I started this just to give an idea of what my approach is. It's also to get my own thoughts down onto quote unquote paper and help me stay organized. But hopefully, it's helpful to some of you. So I'm going to try to get these out Saturdays, usually Saturday mornings. I'm running late here, as you can see. The market's already open tonight, but the idea will be to have this out by Saturday so we can make our plans, and hopefully some of this again is useful to you. So what I wanted to show here is my overall approach. I tend to do weekly trading plans. Again, every Saturday morning I sit down and sort of look at the data. Now, I think most people make the mistake of going straight to their charts and making their assessments that way. I don't believe in that. I do like charts. They're good for seeing what the market's done, but honestly, they're not telling you what it's going to do. They can provide some sort of idea, but we've all been burned by our charts before, I can assure you that. So a few years ago, I started looking for something else. I'm really just trying to get why. So if you look at these charts, finding out why these things happen, not that they did happen, basically. And what I found is there's a really useful tool. And I started compiling this data from the Commitment of Traders report that the CFTC puts out every week. Looks like this. I'll show you where you get it from. This is the U.S. Commodity Futures Trading Commission. So public report comes out every Friday, but it's frozen as of Tuesday of that week. So the data prints on Tuesday or is collected on Tuesday, and it prints on Friday. That sounds, in this world of like a fast-moving market, that sounds really slow. But you're not looking at it for just 1 week's worth of data. You really want to be using this to identify trends as they're developing and know who's buying and who's selling. And I think that's the most important thing, so I'll repeat it. This is just telling us who is buying and who is selling. So a lot of times it will explain why your technical analysis has failed you in the past. Whereas you might have found a beautiful chart set up and it didn't play out. It's because the wrong people were looking at the same thing you were. So with that being said, I'll go through this real quick through the categories. You have dealer, institutional, leveraged funds. Those are hedge funds. These are other reportables, people who or companies who have to report their positions but aren't necessarily in the business. They're doing it for other reasons. This might be a central bank for all I know. But anyway, then you get over to this category, the non-reportable. This is what we are doing. We are the non-reportables, retail traders. As you know, since we're mostly wrong, you don't really want to follow what we're doing. In fact, you might want to fade it and be doing the opposite. But essentially what you really want to be paying attention to on that report is what these guys are doing, the institutional money managers. They tend to be right. And they also make up the largest positioning. So there's this whole supply and demand aspect of that, is these guys make up most of the positioning. They can move the product. And obviously the futures are a derivative, so they move with SPY or the SPX. But there's still some evidence to be sought from this. But anyway, so what I'm looking for mostly is this net positioning. All right. So net being long minus short, or short minus long if they're short. And then I'm looking at the change, that most importantly. So, and this could change pretty dramatically week over week and mean nothing. But if you see it as an overall trend, you don't want to ignore it. In fact, you want to be trying to ride their coattails because they tend to win. So anyway, this will give you some confidence in your trading. If you know that you have these guys backing your trades, essentially. You're doing the same thing they're doing. You can see times, and if you look at these double underlines here, those are pivot points. This was the all-time high that we set in July. And you can see that they started selling while the market was still rising. And then they really let go in that first week of August. They moved the market, period. And let's go back to another big one. Everybody remembers December 24th. Happened to be a Tuesday. Perfect. So look what they were doing while you were selling, panicking. They were buying, continued buying. That was actually their biggest change in positioning, I think. And this goes back 3 years. What you're looking at is sort of a heat map. Pretty simple tool you can use on Excel color scales. But anyway, you can see that they bottomed it. They were the ones accumulating. And look who was selling. Retail. And then retail kept trying to sell it on into the first quarter that was up 20 something percent. So as you can see, this is us. We suck. We're we're failing miserably, and we're also making knee-jerk reactions. There's no consistency in our moves. It's shifting back and forth week over week, as they tend to have a little bit more of a consistent approach, and they also tend to hold longer. They have longer holder periods than hedge funds or us. So really watch what they're doing. Now, I put this into a chart, and what you're seeing here is the S&P 500 in blue, and then you have this gray line, which is basically institutional positioning, and you see it even better than you could on that sheet. You can see they're dumping, making it go down, basically, and then they're picking it back up here. They're buying in December, loading up, and taking profit up here. And so if you're able to catch these as they're happening, you can usually kind of tell because it'll coincide with what's going on your charts. You can use it and make a lot of money doing so, just following these guys. But anyway, so getting back to this week, how I want to approach this week, we can see by this chart, institutions have started picking up their long exposure again. It sort of dipped back there in August, which could be seen obviously in the charts as well. But they really had taken it down heavily from this high point of 957 net long, which is the longest they've been since January 2018, right before we had that big nasty correction. So them dumping it back then pushed the market down. So this happens over and over and over again. You can't ignore it. You have to use it. So anyway, you can see over the last, you're looking for trend. You're not just looking for one sort of outlier. You see over the last 5 weeks, they've been adding, aside from that one little detail there where they did sell down some or added shorts. Who knows why? But in general, we're headed up, right? Green, green, green. So we're looking for buys, even though if you go look straight technical analysis, there's not a lot to be happy about on that last week's candle. Not a lot to be bullish. So it makes sense. I can understand why retail sentiment is pretty dour right now. The reality is that what you're probably going to see is technical analysis get upset again this week. It's my assumption. I believe that we're probably going to retest the lows that we hit on Friday of last week. It was a very convenient spot to sort of catch some support. It was our 50-day moving average. I'm not a big fan of using moving averages too much, but when a substantial one like the 50 or the 200 gets rubbed against, I'm watching that. Okay, that's when I start saying, okay, well, that was the 50-day moving average. That was our buy point. Now I'll make something very clear. Although I did buy Friday afternoon somewhere in the low 50s, I sold it at the close. I do not hold over weekends, and I don't recommend that anybody do that. These are highly leveraged products. Anything can happen over the weekend to sway sentiment one way or the other and push the market. You do not want your stop getting run. You don't want to have your weekend end with a stop run. So just close your positions on Friday, and if you miss a move, who cares? Okay. So my expectations for this week were sort of upset. Like I said, I like to have this out by Saturday, but I'll be just totally honest that I expected us to gap down tonight and then get picked up from there. I expected us to gap down into the 50s. I view gaps as sort of contrarian things. They're trend exhaustion. So this kind of troubles me, but I'm going to go ahead and go through with what my analysis was before I saw this happen. So again, let me make that clear. I don't like gaps. If I'm bullish and it gaps up, I'm actually kind of worried about my long position or my sentiment. Maybe I'm wrong, and I was expecting it to gap down, which what I would view as a bullish thing. I know that sounds counterintuitive, but it's not. It's basically where sentiment has swung too far to the other side, and it doesn't usually end up well for people who are short. They need to take their profit. If you get that gap, take your profit. Move on with your life. Anyway, as you can see, gapped up and filled back down. I expected the opposite. I expect us to gap down somewhere in here, and I was going to buy with a stop pretty loose, assuming that we were bottoming. I still expect that to happen. I do expect this to drift down overnight now and give me a nice entry in the morning. That's at least what I hope at this point. So my assumption is that for the week, let me go back to weekly. Sorry if I'm scooting around too fast. But anyway, for the week, I expect us to have a bullish engulfing candle here. I expect us to drop down a little bit above those lows from Friday. I expect it to get picked up, and I expect it to move upward. I don't know that, barring any news, there can always be a tweet one way or the other that throws everybody's technical analysis or whatever it might be off. But I don't believe that we break this high of 30.12, which was last week's high. I don't think we're going to do that this week, but I do believe we close at the upper end of that range. So what I'm expecting essentially is about a 62 point, or let's just say 60 point range for the week. So from that, we're looking for buys early on, or any dips we need to be buying. I do expect over the next few weeks, at some point, we're going to retest this line, which, again, I'm not a big trend line guy, but also you can not be a big trend line guy, but you also can't ignore something that has been held 1, 2, 3 times. So what I'm saying here is that I believe that this move up was sort of incomplete, and I think we're going to go finish it. I think we're going to, at some point in October, be up here by this 30.50 range, 30.55-ish, somewhere in there. And I believe at that point, maybe at the end of October, we drop again. The pattern has really been, if you look at things in terms of time, we've been having these pullbacks. This one was, I think, 6%, and then this one was 8%. We've been having those every 3 months on the nose, basically after Apple reports earnings, April 30th, July 30th. Things been dropping. So that's what I'm seeing. You're looking at the end of October for a bull run, but we'll have many videos in between there. Other than that, buy the dips, use your stops, protect yourself. There's always another trade. If you're wrong, be wrong, and let it take your money, and then move on to the next trade. Do not try to hold through something just to be right. It's probably the most important rule I ever learned to trading. It's okay to be wrong. But anyway, good luck, everyone. I hope you enjoyed this video. I hope it was helpful. Feel free to comment any questions you may have, and subscribe. Well, have a great week.